This is a real pleasure having these three guys on. I'm a very, very, very tough critic. My students generally either love me or I won't say they hate me. They just appreciate that I'm a very tough teacher. But Sameer, Douglas, and Peng are three really, really brilliant guys, and we're really, really lucky to have them. And so I'm going to basically stop talking, and well, I'll moderate as as little as possible because I'm not going to have the value to add that these guys do. But I think we've got to start with GameStop. It's the conversation du jour. Volatility there that we've never seen in many respects. The Volkswagen run up was pretty gigantic. But anyway, Douglas, Peng, Sameer, which one do you guys want to start first on this?
Yeah, I guess I can start. So GameStop, yeah, interesting situation. So I think it actually is something that we've been looking at. By the way, so I cover machine learning and alternative data research at JPMorgan. So actually, we've been looking at GameStop for, not GameStop specifically, but the retail phenomenon for a while, starting last year, because even, let's say in mid last year, we've started seeing kind of, retail investors impact on a number of stocks. So Kodak, Hertz, right? And even silver ETF, for example. And at that time, we actually we were lucky enough to have Robinhood making their data available. So we could actually use Robinhood data to kind of analyze, okay, are retail investors actually having impacts, or are they having kind of any signaling effects on these stocks? And actually, the conclusion we found at that time was even though the retail flow, they were ridiculed oftentimes as being uninformed traders, but they do actually in the short term have some kind of predictive power. By short term, I mean probably a week to a month horizon. Okay, they do have some kind of predictive power. So stocks that are favored by retail investors tend to outperform, and those that are sold by retail investors tend to underperform. But obviously, Robinhood, as we all know, discontinued this data. But fortunately, actually, there are other research being done, and since this is kind of an academic conference, I'm sure a lot of you might have seen a paper by Bomer, Jones, and Zhang, like these four authors. That's the paper is going to be published in Journal of Finance shortly on how to identify retail flow using market microstructure data. And we've actually implemented this algorithm just recently, and we found it to be very, very, very helpful in identifying, okay, which stocks are actually driven by retail flow and which stocks, despite the appearance, are not actually driven by retail flow. And actually GameStop is one of those stocks that the retail flow actually appeared to be relatively moderate, okay, compared to some of the other stocks, like AMC, for example, or like some of these EV names. So that's something I think quite interesting and a little bit counterintuitive, but I guess the point here is to say, okay, like with new interesting alternative data, we're able to get a good understanding, get a good handle on, okay, which stocks are retail favorites, which ones are not. And of course, if you just look at the order flow, for example, you can only, it's kind of like backward looking, right? But you can combine it with some other alternative data, like you can scrape Reddit, for example, or you can scrape Twitter, whatever it is. And you can combine these two, and I think it can be very powerful going forward.
By the way, Dr. Linda Kreitzman, who runs Berkeley's financial engineering department, is just one of Peng's biggest fans in the world. Peng is a Berkeley grad, which is, by the way, Berkeley has been the #1 financial engineering school globally. I think 5 years in a row now. Peng, it's pretty remarkable. But and Dr. Kreitzman, who's been there for now 20 years, just is absolutely one of your biggest fans. Thinks you're really just the best. So.
No, I'm her biggest fan as well.
Oh no, well, it goes both ways. But anyway, you guys, I guess you became #1 again for the 5th year in a row. So congratulations. I love Berkeley, but my heart's obviously with Cornell, and we are not #1. But anyway, Douglas, we'd love to hear your thoughts on GameStop.
Yeah, I think our view here is a little different from what Cheng and Sameer might offer, since we're an exchange. And of course, so I'm, by the way, Douglas Hamilton. I head up AI research for NASDAQ, and our opinion is going to be considerably more neutral than what you might hear elsewhere. So to kind of reiterate what our panelists before me said, what the GameStop data really showed us, and to a certain extent AMC and Kodak before then, is a lot of our assumptions about retail traders behaving, kind of randomly, taking positions here or there, trading once or twice a year, really have been upended in the last few months with these enormous retail flows. And instead, it looks much more like a much more concerted and at least quasi-informed group. Now you can say what you will about the quality of the information or the quality of the theses being driven, but they certainly look much more informed than we've seen in the past. For me as a machine learning, as heading up a machine learning lab, the challenge this really brings about is an ancient challenge in ML, which is data shift. So if we're trying to understand the behavior of retail traders, because we'd like to either make sure that they're better informed about how to hedge their risk or make a good investment thesis, or the machinery of the complex machinery of modern financial markets, then historical data about how retail traders have behaved is probably something that we're not going to be able to rely on nearly as much anymore. And it also kind of shows us another classic problem in financial economics and finance more broadly, which is that these large tail events can have outsized impacts on the market as well. And of course, also outsized impact on the wallets of retail investors. So, when we think about the GameStop phenomenon, the Kodak phenomenon, et cetera, I think those are really the things that we're most keenly interested in, is how we can make sure that the new retail investor is sufficiently well informed and armed to trade and engage in financial markets in ways that are sensible and won't have them YOLO their way into oblivion.
Very well said. Sameer, do you want to add anything to that?
Yeah, I think. Thanks, Alex. I think both Peng and Doug offered some very interesting perspectives. Something I was going to talk about, but I think I'll just almost bring it together. Where I think what this particular example of Reddit and Wall Street Bets and GameStop and AMC and all these names showed us is the democratization of information that's been happening. And I think it just solidified that notion that information is no longer concentrated in a Bloomberg terminal or between a fund and a sell-side bank, but it's out there. And the question is, today, Peng, you mentioned that, sort of, retail flow. Tomorrow it could be something else. Today it was on Reddit. Tomorrow it could be on some other, Clubhouse, the new rage, which is, so how do you kind of constantly, it's like a moving target. And I think that's what I've been seeing with all data in general, that there's so much proliferation of data. So democratization is a great thing because it even, or levels the playing field, but at the same time, it's very challenging in terms of where do you point your gun? And you're constantly just looking for, where to look. So I think it really points to, some building your infrastructure such that you can shift focus when you need to, or you can focus on the right thing, but then your scope is much wider. And then I think it also goes into leveraging what's out there, so you don't have to build everything, but leveraging things that might already be available, but bringing them together in a very integrated way, so you have a unified view of the market. I'll stop at that.
So the next question is for Douglas. The evolution of machine learning use cases for exchange operators or financial services, has really come into focus recently, and I'd love it if you could expand on that for our audience today.
Sure. Yeah. So, the group I lead at NASDAQ has been around for about 4 years now, and before I did this, like I'm sure many people in finance, I went out and tried to save the real world by doing AI for manufacturing at Boeing. And that was spent a couple of years there. So that's about 5-6 years ago now. And one of my favorite parts about this field, machine learning and AI, is 5 or 6 years ago is ancient history at this point. The things that were cutting edge then are now rather passé. And really, when I think about the evolution of machine learning over the last 6 years, at least for exchange operators and corporates, really what I think we've seen, and I suspect we've seen this also in funds as well, is an evolution away from kind of descriptive analytics and machine learning as a tool to inform an investment thesis, and towards kind of a reliance on machine learning to drive control systems. So I'll give you a great example of this. One of the first things I did at my first firm was to use natural language processing to figure out where a particular sort of defect was occurring on a manufacturing line, right, historically. So that's very descriptive. No, we're not going to be able to tell you how often it's going to occur. We're not going to be able to tell you, how to fix it, but we can at least tell you, here's where your problem is, and here's where most of the hours are being spent, right, in rework. If we fast forward to today, we at the Machine Intelligence Lab, we use machine learning for everything from detecting instances of market abuse to constructing portfolios for our index business. And those are much more positive, positive elements of control, or much more tip of the spear elements of control that we're actually applying. And I think, when you look at the last few years of advances in AI, whether it's transfer learning, whether it's recurrent nets, et cetera, a lot of them have been less about getting massive improvements in the accuracy of our models, and much more in making them more reliable, more reusable, and more fit for business purposes. And that allows them to be much closer to the action, rather than sitting, on the hard drive of some analyst who's going to then go put the results of it into a PowerPoint. So I really think that's been the guiding light, or the direction that machine learning is going, is away from the analyst and towards and almost into the computer, right, into computation and into systems. And I have to imagine that's a trend we're going to accelerate in the coming years.
Yeah, no, I fully agree. Peng, would you like to add anything to that?
Yeah, I think 5 or 6 years ago, I remember, like, when you talk about machine learning, everyone's goal was probably, what is your Y variable in your model? It's probably just to generate higher Sharpe ratio or generate abnormal return, But I think now people have more understanding of, the limitations of machine learning, where it's best used for. So the kind of target variable, or the Y variable we try to solve for, is much more focused. And I think,
yes,
like linear regression, the linear models continue to be great. In fact, when benchmarked against some of these machine learning models, they are very robust. They work extremely well out of sample.
Ew, yes, no.
And
many of AQR's best strategies are still run on linear regression, and they got hammered in 2008 when the valuations became less relevant, but they just kind of stuck with them, and they kept profiting. So
yeah, and I think one of the most surprising thing of getting into machine learning is that how difficult it is actually to be the linear regression model. But so and I agree that, okay, let's say even if you look at the performance of the model from a Sharpe ratio kind of perspective, maybe with a linear model you can achieve a Sharpe ratio of 1 for a certain strategy. Maybe if you switch to nonlinear model, machine learning based model, so to speak, maybe you can improve it to 1.1, 1.2, and that's already something we're pretty happy about. So that's kind of like, I think, probably the general view on machine learning. It's kind of like quantum computer, right? Like like the traditional computer will still do most of the work. The quantum computer is good at solving certain very specific problems. I think that's kind of the relationship between, let's say, machine learning models and linear models.
Now, quantum really needs to be very specific, and I question how useful quantum is going to be in finance for a while, and to kind of make the data useful for quantum, I don't know. Douglas, do you have an opinion on quantum while we're here? Or Sameer, either of you guys, or does anyone want to touch on quantum while we're talking about it?
I do. I think obviously there's an enormous amount of excitement around quantum computing, but I think Ken got it perfectly correct, right? The use cases are narrow, right? There's a very famous, I think it was actually Shor who came out with this again, right? Who noted that after 40 years of research, we've still only found 3 really good use cases for quantum computing. And there've been a lot of really smart people trying really hard to find better use cases of those three. Now, it happens that those three are really important use cases, right? Figuring out if a number is prime really quickly has some really serious implications. Being able to solve really complex hill climbing problems very, very quickly in a more optimal way. I mean, I think that's basically what everybody here does all day, every day. So it definitely is exciting, but it's early. We are real early. I mean, the biggest challenge that quantum computing faces right now is the programming languages are intractable. Two, the underlying chips are reasonably powerful if they didn't have any noise, but they have lots of noise and they spend all their time correcting the errors in their own computation. I was reading a paper from one of the vendors once, I think it was a couple of years ago, and basically their simulation of a quantum computer at like 8 qubits was outperforming the actual thing at 30 because one of them was noiseless and the other one noisy. So we're definitely a long ways away. I'm reasonably excited about quantum for solving various sorts of portfolio optimization problems, particularly very, very, very large portfolio optimization problems. So if you think about from an exchange provider perspective, how we think about our portfolio of, say, options that we offer to the world would be a good example of a portfolio that today would be very difficult to manage with classical computing, but one that maybe you could tackle with quantum.
So I think that's very interesting. Doug, you hit it on the head when you say that for quantum to be adopted, there has to be a simple enough programming language for developers to feel comfortable, solving problems with the right set of tools and things like that. And I think it's missing all of that. I think the thing that makes me excited about quantum, though, is a couple of very big use cases, what I would say. And this is my hypothesis. I don't know how much quantum hits them well enough. The first one is just AI and ML. If you think about, as ESG becomes a thing, as people start to, actively from CEO level down, start thinking about their ESG footprint and how, their businesses are using energy. I mean, AI and ML models are, left to their own devices. We all know that they could really consume a lot of energy, and whether they're running with a cloud provider or an on-prem setting, that's indifferent. But you are responsible for that ESG footprint. And I feel like I always used to think that nuclear energy might be the answer to sort of like not going after the sources of fuel or energy we have today. But I think quantum to me is a really nice, safe bet. Not as powerful as nuclear, but something that will, help us kind of conserve energy. And by doing all the good things we want to do in AI and ML, but doing it in a very responsible and an energy efficient way. The second use case that I feel is could be extremely relevant to quantum is blockchain. So, we talk about Ethereum and Bitcoin both still struggling to be able to scale. And the gas fees are still really, really high because it just takes an enormous amount of energy to record and validate a transaction on a blockchain. Quantum can do that like at fractions of the fees or the energy or the effort it takes to record those. So I think blockchain again, quantum goes back to the point you made, Doug. It has to be offered in a very user-friendly way. I think one good tailwind there is that you don't have to buy quantum computer like you have to buy mainframes. With all the cloud providers, including, of course, IBM is the pioneer here, but I think Google and Microsoft are not too far behind getting, quantum computer as a service in the cloud, right? So that will be available. You'll be able to timeshare your way, not even timeshare. You'll be able to get your resources when you need them, how much you need them. But I think it's just the understanding, the languages, the tools that need to evolve really quickly. And I believe the use cases will force us down that path very soon.
Well, I personally still love nuclear power. I think it's the great misunderstood power. And my good buddy, Professor Timothy Mousseau of USC, actually was the UN's chair for the Fukushima investigation. And just a few years later, you can fish right by Fukushima. That will be usable. So, you know, I think nuclear power still has a great many benefits. Of course, let's not get into nuclear power. Let's stick to data. And Sameer, I want to know, how much of your day do you spend cleaning data still at this point?
Pretty significant part, and I think let you know, I'll take a step back on that question a little bit, Alex. You know, cleaning data is, I would call it as staging data. So cleaning data is really almost like a misnomer for, you know, what goes on behind it in order for data to be ready for an AI and ML application. And, you know, when you talk about staging data, there's a lot of different stages involved. So what do you do after you've ingested the data? You run some basic data quality checks. You know, you run a lot of enrichments. For example, you have to tag the data. You know, case in point, if you're taking in alternative data on credit card transactions, those transactions only mention a brand, and sometimes even the brand is mentioned in shorthand notation. So that's where, like, you know, you can use ML techniques to sort of do a tagging from brand to company, but then the company itself is not enough. You know, then you tag it back to a ticker. Then ticker itself is not enough, especially if you have to join data across a lot of different data sources and data sets that may not have the same terminology. So then you have to join it to something, you know, which becomes a unique identifier. So all of that tagging activity, if you don't do it right, your downstream AI systems can absolutely, you know, like they're just like useless because, you know, they're just going on garbage in, garbage out type of syndrome. Then, you know, once you've done that, you have to do the data normalization. You have to catalog the data. So I'm now getting into a little bit of governance activities where if you don't create a unified data model, again, data discovery becomes a challenge. And, you know, you could run a couple of models and you can sort of, you know, exactly what I just said. You can handcraft that and you can hand curate it and you can do a really good thing. But if somebody says, well, Alex, these two models work really well, how about creating 20 clones of these? And that's when I think, you know, all the stuff that I've said in response to your cleaning question, Alex, if you have not done that in a scalable and as automated way, a way as possible, you know, it will really make you choke at the glamorous end of the funnel because, you know, you won't be able to find scale there. So, you know, long story short, very important for us to figure out how do we think about cleaning the data. And it's not about, you know, you have to identify the design patterns, the common patterns that you can then try to automate through people, through processes, through technologies and tools to sort of build scale there and then go from there.
Yeah. Peng, do you want to jump in here?
Yeah, actually, I think if you ask me what percentage of my work is on cleaning data, I would say that probably all of our work can be classified as cleaning the data because, you know, you have the kind of explicit then kind of data cleaning part, right? Where it's like, you know, as Sameer described, okay, try to eliminate outliers, try to match the identifiers, et cetera, But, you know, so that's the explicit part. But, you know, in the modeling stage, you're also kind of manipulating the data in such a way to make it usable, right? To give you an example, like, for example, I have, let's say 3,000 stocks, but some of them, I may not have that much data. So, and my estimates on certain tickers, they may not be very reliable, okay? And this could just be like linear regressions, for example, you know? And what do I do now? I may do a Bayesian model, right? Where I shrink my estimates on these names towards, let's say, my prior or general population. So, you know, I think, you know, that's will be considered a form of data cleaning, right? In the sense that if I had enough data, I wouldn't have to overlay or impose a more sophisticated model. But now that I don't have enough data, I have to compensate by, you know, tweaking the model to make it more robust, for example, you know. So like in the ideal case, things would just be simple and beautiful, right? I have a very clean set of data. I just, apply a very simple model. It could be just ranking percentiles. It could be just a linear model, and then I can generate signals based on it, right? That would require zero data cleaning. But in the real world, what I have to not only clean the data explicitly, but in the model choice, I also kind of need to be aware of what are my limitations, my data limitations. So, like I would say almost 99% of the time, your work, it has got to do with the data you have.
Douglas, I'd love to hear your perspective on this.
Sure.
And I mean, at NASDAQ, you must be faced with just, obviously you'll tell us.
Yeah, so I'll give the frank answer. I spend no time cleaning data now. I offloaded all that back in 2017 so I could work on the fun stuff. But the junior data scientist I offloaded it to, how much do they spend? Well, I'll be a little more, I think I'm going to take an idiosyncratic view here to our other panelists. I think I can certainly appreciate the challenge of having incredibly messy data. I'll go back to my prior life in manufacturing. We spent a lot of time interpreting the notes of mechanics on a factory floor who have to put a string into the computer to submit a form. But the string doesn't have to say anything. So if you just smash your face against the keyboard, it counts, and that goes into our database. So, in that life, certainly we spent a lot of time cleaning data. I actually feel in a lot of ways kind of fortunate because the data that we work with at NASDAQ is pretty clean, right? We have incredibly high reliability systems. They don't hiccup. We look at, very reliable data feeds. We don't really have enormous amounts of missing financial data that we have to comb through. And maybe to really underscore this difference between, working with our exchange data versus alternative data, we recently had a group of interns with us over January, and I would say that they spent the first 2 weeks of their internship, it's a 4-week internship, cleaning and engineering features on the data that we presented them. If we were to compare and contrast that with an earlier line of business that we pursued around alternative data, a line of business that later became associated with Quandl, an alternative data set that we ingested and tried to assess the value of. We could spend. So
Quandl is NASDAQ's alternative data unit, yes?
Yes, yeah, that's our alternative data business.
So Quandl's head of data is one of my favorite people on the planet. Bill Daig is just so phenomenal. I just love that guy.
Yeah, he's a very interesting guy. He's a very good speaker. He's very good at this sort of stuff. He is great. He's been phenomenal. He was actually on my team when I first started at NASDAQ. So
one of I've probably been to 200 conferences in my life. My first job was Morgan Stanley in '96. I saw Michael Recchi, who used to be Point72's head of data and now is Neuberger Berman's head of data, and Bill Daig get into a little bit of the closest you could ever call it to an argument, but it was really fantastic because the two most respectful, genteel, really fantastic people out there. Michael Recchi is at Neuberger Berman is just another, like Bill Daig, is another superstar A+ person. Yeah. Like you three all are, by the way. Our three panelists are just as phenomenal as they come. I really can't emphasize that enough because I'm generally a very, very, very critical person. And so, of course, NASDAQ, JPMorgan, and Point72 are, the creme de la creme of corporate brands, really. You guys, it doesn't get better than that. But anyway, I love all three perspectives. And so while we're on data, let's talk about alternative data. Douglas, do you want to start us off, or?
Yeah. So when it comes, I'll start us off. I mean, we've kind of moved a little. The alternative data business has been spun off into its own thing. So I don't deal with a huge amount of alternative data today, but I can paraphrase. A client call is on.
It's all my students want is to work on alternative data. It's like all that alternative data, alternative data, alternative data.
Yeah, you should be careful what you wish for. I'll paraphrase one of a client call we were on once, and I will also echo the sentiment, which is alternative data is really expensive to onboard. It's really expensive to work with. It's really expensive to understand, and almost all of it is crap in backtest. And it's even worse when you actually use it. So it's tricky, and there's been been a huge number of studies on this. I think, you know, my favorite may have come from Quantopian, who's looking at alternative database strategies, and I think they were looking at alternative database strategies and stability of various metrics to produce returns on those outside of backtest, and just found it was so incredibly variant. Now, with all that, you know, I think the alternative data is coming. Alternative data is important, and when people find alternative data sets that they like, they really, really like them, and are willing to pay quite a bit of money for them for obvious reasons, because they can get a lot of alpha. You know, the propagation and increase in the amount of data in the world isn't slowing down. There's always going to be more data to use, and a lot of that data is only going to be tangentially inculcated into the market already. So, you know, there's going to be some opportunity for arbitrage there, or, you know, statistical arbitrage. But
well, can I actually interrupt you and ask a question that just popped into my head out of nowhere? I apologize. This might be the dumbest question in the world, and so I apologize, Douglas. But I was just thinking, you know, the 13F, they might get rid of 13Fs. If they do that, I know all these hedge funds use that data. At the NASDAQ, don't you know who owns every stock every day? Couldn't you then alternatively sell that data then if they got rid of it?
You know, I really like my job, and I'd like to keep it. So I'm not going to comment on us selling the positions of our. Well,
they're probably not going to do away with that law anyway. Apparently,
yeah,
everybody.
Yeah.
It didn't make any sense. It kind of went in the opposite direction of how everything's been flowing the last 40 years. But yeah, no, somebody's palms got very greased with that situation.
Yeah.
But yeah. No, anyway, sorry, keep going, Douglas.
Yeah, so you know, alternative data is coming. It's obviously people need to work with it, and the question really is, how do you find alternative data that's at all useful? And, you know, at least as a first pass, you know, what we found when we were dealing with alternative data, I know what one of our, you know, it plays a large role at Quantum, is how we can use machine learning systems and various other automated systems to very quickly, you know, at least get rid of the chaff from the wheat before doing some more, you know, deep and thorough analysis of what's out there and what's coming in. Because otherwise, you're just trapped in a world where you spend 100 hours looking at, you know, 100 hours looking at cell phone telemetry data and trying to figure out if knowing where Doug was today, you know, knowing that I went to the coffee shop and then the liquor store at 9 a.m. Is useful information for your trading strategy or not. And most oftentimes it's not.
Yeah, no, that's a really great point. It's so hard to make use out of good alternative data. It really, anyway, but let's, you know, I'm not a panelist. Peng, do you want to jump in here?
Yeah, I think, first of all, I totally agree. Like, I've seen so many different data sets in the last few years that some of them really amaze me. Like, you know, somebody mentioned, okay, the length of your index finger versus your ring finger, like that's apparently some indicator of whether a person is a good trader or not, you know? So some of them can be quite esoteric. I don't know if they actually bring you alpha, but I think, you know, like, let's say if I were to look for alternative data, right? What would I focus on out of the sea of options? I would say probably, you know, some of the stuff that I know, some of the existing data, right, in which I know will work if we can increase the quality of this data. So let's say CFTC futures positioning data, for example, as an example, right? So these are, you know, on commodities or on some other, you know, equity financial futures, for example, that are released on a Friday, but, you know, the data is only available as of the most recent Tuesday, so there's a 3-day lag, and then it's only of weekly frequency. So, but I know that a lot of investors, they make use of this kind of data. Now, when I ask them, okay, how do you use this data? Some people say, yeah, I'm able to extract signal out of it. Others, you know, maybe less so, but, you know, I've never been able to extract this kind of signal out of this kind of data, given the 3-day lag, given the weekly frequency. But let's say if there is a data set which proxies this data, but with little lag, right, and with higher frequency, then it may very well be possible to produce trading signals based on this alternative data. So you know, like at the moment, I think that's the kind of data sets I would focus on, which is, you know, traditional data, which I know would bring me alpha if I can have a higher frequency estimates, where I can have a lower lag, you know. Then, you know, if these are the data that make my traditional data more valuable, then, you know, these are the ones could be worth looking into. So you're not just kind of looking for a needle in a haystack, but instead you can kind of, at least, a priori that this data is going to work. So that's kind of my experience right now.
Sameer, would you like to jump in here?
Yeah, so this is, I've obviously run the all data.
Well, first of all,
sourcing.
before you answer this question, Sameer, since, at Point72, you guys must get pitched by every single data provider that's, ever existed on the planet. How much of this alternative data that you looked at to you seems like just junk? And then please go in and answer as you will.
I think, yeah, so Alex, to that point, I've run the global data sourcing and strategy team for, can you hear me fine?
Yeah, no,
sorry.
Yeah.
So I used to run the global data sourcing team for Point72 that was involved in buying any and every type of alternative data that fit into our mandate globally. And that job is getting harder and harder, as you said, Alex. I am constantly, and even though I'm not in the seat anymore, I'm constantly getting approached by all sorts of vendors, new and established, and one person show and then 1,000 people team saying that, look, we've got this interesting data set. And I think all of that, I would say, is and can be interesting based on the context you're in. So, if you are an investor who's going after certain themes, right? So let's say ESG is an emerging theme for me, or crypto is not a stock. I mean, it's not like a tradable universe yet in the true security sense. Let's stick to ESG. Then once you have that theme, your traditional data sets may not even exist, right? Or there may be MSCI may be putting out something, or Refinitiv might have something, Bloomberg might have something, but just very, very limited data. And therefore, in order for you to really do some meaningful, bottoms up fundamental work, you will need more data sets. So I think in that context, capabilities, I'm not saying, I don't think it's a game of I've got 1,000 data sets and I'm working with them. Tomorrow I have 5,000. I don't think that's the game. I think the game is, when there is a need for something, do I have the right infrastructure in place to be able to sort of say, yes, ESG, here are the 1,000 things that may be out there. And then I have a very quick way to sort of, based on what I'm looking for, being able to rapidly test all of them and then say, yes, this is the short list of 10, and then to quickly sort of compare descriptive stats around those 10, and then maybe bringing in a couple of data sets, very, very quickly being able to rapidly test them. Chances are they may not be, as Doug mentioned, they may not have the identifier that I know, right? They may even not have the company name. How do I quickly match it? How do I quickly, to Peng's point on outliers and the spurious rows, how do I quickly drop them? And then very quickly say, yes, this is the data set that I can work with. I understand it's got its limitations, but I'll do the best I can to get insights where they make sense. And then once that is done, you move on to the next theme. 5G becomes a theme 1 year from now. So you sort of start looking at that. So I don't think, any data set will basically stay with you for the rest of your career. It's not stock prices. I think credit card transactions probably one of those all data categories that have become staple, like a Bloomberg type of, data source. But I think all the other fringe data sets, Reddit scraping, Peng, you mentioned that, right? Maybe Reddit is hot for the next 3 years, and then all the information flow goes to the next Reddit, right? So you almost, I think it's the muscle. It's the muscle that you need to develop. It's part of your AI muscle. It's evolving. You can't do it overnight, and that muscle involves being able to get these data sets at scale, test these data sets at scale, integrate these data sets at scale, and sunset them when you see the utility or the marginal utility of that sort of or declining, and then something else sort of replaces that.
and look at what are unique challenges that financial service firms have in applying AI. And so obviously, three very different firms here. Let's start with Douglas. For NASDAQ, I'd love for you to answer this question.
Yeah, so I mean, I think while it's unique, I suspect we have many of the same. So I like going first here because I get the easy ones. So the first is that, I think undoubtedly, if you were to compare extracting signals from a financial market, particularly high performing ones, to let's say facial recognition, what we'd probably note is that the underlying fundamentals that define a good strategy in a financial market evolve slightly more quickly than your face does, right? Than a human face does. So you just have a much higher velocity of data shift than I think you have in almost any other domain in the world, with the possible exception of something like cybersecurity, which is so naturally adversarial that as soon as you solve the problem changes. So I think that's got to be our first one. The second, which is related then, is kind of this notion of market regime or market domain. When we think about how we might use AI for market structure, we very oftentimes have to think about different models for different market regimes, whether that's models that perform well in momentum regimes or inversion regimes, ones that work well for regimes that are where volume is where more volume is disproportionately attracted to large caps versus small caps, et cetera. And even for particular market events like a Russell rebalance, for example, will have its own very unique and different sort of underlying dynamics. I think that's really the core challenge, is that we don't have stable underlying distributions. I'd say a secondary challenge then is that it's difficult to really parameterize our underlying distributions in nice ways, right? Almost everything we do, we don't care about normal operating conditions. We care about extreme operating conditions because we kind of figured out as an exchange operator how to deal with normal operating conditions. And a lot of the value then comes from these extreme events. So when people talk about removing outliers, certainly we have to remove outliers. We also have to be very careful that we don't remove the things that matter when we remove those outliers. So I think those are really our two defining challenges in financial services. Very rapid data shift problems with resulting in multiple regimes that we need to study, as well as kind of this problem of our world being disproportionately impacted by extreme events that you don't necessarily see elsewhere.
Wow, very well put, Douglas. Fantastic. Peng, do you want to jump in here?
Yeah, I think as Douglas pointed out, he's already picked off the easier ones. So I think maybe more on the structural side of the financial markets, I can be throwing my 2 cents. I would say that one thing that kind of differentiates the financial sector from, let's say, technology or other sectors is that all the market participants, there's no open source in this field. Like let's say if I find a model that works, I'm not going to tell anybody else, right? This is very different from, let's say, if Google comes up with a good NLP model or whatever it is, then they'll just make it public and everyone can use it. Whereas in finance, if you found something really, really useful, something really, really profitable, almost by definition you cannot publish it, because the minute you publish it, it becomes useless, right? But like let's say if you don't publish it, you keep it to yourself, then maybe no one will ever discover it, and this is. Okay, it could be good for the firm that discovered it, but not necessarily good for our field. So I think that's probably one of the biggest challenge that we have seen. Everyone's trying to find out what other people are doing, but at the same time, they're not very happy to share. Now, of course, we work in public research, so we don't have a problem. But that's been kind of experience. I have interacting with a lot of buy side clients.
I can piggyback on that real quick. When I joined NASDAQ several years ago, 4 years ago, and I was trying to figure out like what might be useful in this industry, I made the mistake of first trying to apply the things that banks were publishing, and after about 6 months, realized that you should be looking for the architectures and fields in AI that they're not publishing about, and that's probably where there's a little more a little more sauce for the squeeze.
Sameer, you want to jump in here?
Yeah, I think I would say that there are a couple of challenges from what I have observed. First one is creating a problem statement that's well scoped in the context of tools and data available becomes a very hard exercise in terms of the talent available to work on them. And then just the sheer fact that the talent is still siloed. So and that's the first one. The second one is, I would say, there is not enough data, not going to deep details on both. So the first one, which I mentioned, that, how do you frame a problem statement and how do you put the right resources around it? I think it's very siloed today, which leads to pretty long time in between stages from data engineering, looking at data and gathering some insights, passing it on to data science, and then the ultimate business user who basically has to still make a decision. I'm assuming that AI is still years away from, making binary decisions on buy the stock and sell the stock. I just don't think we are there. It can get it right, but when it fails, it'll be game over. So you just can't risk AI to make those decisions where each decision has a very, very high risk factor or risk value. So what you end up, what it ends up doing is putting a human still at the decision table and AI at its disposal of making sure that it's presenting information to the human and covering any of their biases, that could potentially blindside them. So with that context in mind, I just don't think there's enough communication between the various chefs in the kitchen that have to be there. It's very hard for you to say that there's one superstar data scientist who's going to understand what the problem is, the micro problem. Remember, it's not a full problem that you're solving. A micro problem is, and then those micro problems, when integrated, become a much bigger part of the bigger problem. But having that communication go back through different phases of, project managers, BAs, and data scientists, and product managers and data engineers, I think it's just like that communication is broken, and therefore, there's inefficiencies at every point, and there's the game of telephone that gets played where people just miss the context, and then what ends up happening is just like a very suboptimal solution leading to frustration at the end, where somebody's trying to say, this AI is just giving me totally wrong predictions. Well, because the process was broken around that, right? So that's one challenge. Second challenge is, I think this is, within financial services, I just don't think we have enough data. And even if we tell, one of the recent things I was working on was NLP, and it's one of your favorite subjects and topics. And yes, there is a lot of news data. There's a lot of data on the web that you can get. But when you're trying to create an NLP model that you are expecting to read as input financial commentary, like an earnings call, for example, and then on the outbound side, give you, good view of sentiment by management, by analysts, or overall sentiment, I think we are far from there because there's just not enough data. You can take the best Google's NLP, P5 model, and when you start training the model into the context, which is financial services, capital markets here, it just becomes not enough data, and the best model can become highly inaccurate. So and then it begets the question of, well, can we get a nice training data, which is labeled data, and that itself is a big problem. Is there a person who can read through hundreds of thousands of transcripts and broker research reports and basically in a very objective way score them such that when the model trains on them, it becomes a really, really accurate source of training data. That's not there, and therefore I think you're now seeing AI solutions that can help create training on labeled data that will then help create or train an AI model. So it's just like it's a hard problem, and we continue to make progress, but it's slow progress.
Oh no, that's very well put. Really very well put. I want to switch back, or I guess we haven't really touched it yet. I want to touch on just a gigantic subject, crypto, and Bitcoin has been surging. Elon Musk obviously announcing that Tesla is moving into Bitcoin as a holding. So I guess my first question goes to you, Peng. Have you started looking at crypto? How much of your day is crypto? Generally, how has crypto affected your life?
Probably a lot among the speakers here. Zero is the answer. So I don't cover crypto research. There are my colleagues who do look at crypto research. So they are kind of in the maybe rates research, currency research, et cetera, et cetera. So I would say that's kind of the responsibility they have taken on. We don't have an official crypto trading desk, or we don't have an official crypto research desk. So, a lot of this research is spontaneous. So, I personally, why haven't I, started?
Have you seen AI in crypto at all, Peng?
I mean, to be honest, when I look at kind of how crypto has been analyzed, what are the kind of value drivers, et cetera, I would say that, okay, maybe it's actually not such a bad candidate for, let's say, AI trading, okay? Because from what I can see, most of this trading or analysis are largely technical based. Like, I still haven't found anyone who will be able to explain to me, okay, what are the fundamental drivers of cryptocurrency? Most people seem to employ some kind of technical analysis or trend following analysis.
I generally think crypto prices are, reverse fix. And so when, times are good, they're the ultimate manifestation of how big the economic bubble is. But, whatever.
Okay.
So I know.
Well, no, so that's a good point, and, maybe that can be used for analyzing crypto valuation. So, I would say for most investors, it seems like they employ some kind of just, market structure or technical analysis. And actually, pattern recognition and historical pattern analysis actually are the strengths of AI. So maybe it is a good candidate, but I must profess my, ignorance in this field. So I don't have any strong view on it, to be honest.
Yeah, no, as ignorant as can be in crypto, I'm just trying to learn as much as possible. Douglas, do you have anything to add here?
Yeah, so I also spend very little of my day dealing with crypto, though I will say, along with taking a position in Bitcoin, I guess Tesla will now accept Bitcoins for their cars, which means it theoretically has some fundamental underlying value now. But I think where we see kind of AI for crypto is also where we see a lot of our exchange technology. Broadly, crypto exchanges, if you look at the maturity of crypto exchanges compared to the maturity of equities and options exchanges, it's considerably less mature. If you'd like to be able to take the infrastructure of modern finance and apply it to crypto, and I suspect you would in many ways, either to make the exchanges more stable, the pricing potentially more stable, or because oncoming regulation from people like the EU and potentially the US and elsewhere are going to say you've gotta, then we need to be able to apply many of those same rules to crypto markets. And whether that's about how we keep and clear crypto or how we survey those markets, that's something that's going to have to come. And I don't think you want to go and reinvent all the rules for crypto, because ultimately the ways you're going to illicitly engage in that market are the same ways you're going to illicitly engage in other markets as well. So you don't want to have
very well put, Douglas.
Yeah.
Really great point.
Yeah. Yeah. So, I mean, that's kind of the opportunity for AI, is really extending a lot of our modern infrastructure into these crypto markets.
Sameer, do you want to add anything here?
Yeah, I think I'm just gonna probably have a different view, less on AI, but like more on crypto, just for the sake of, because it's been an area of interest for me personally. I think I do believe that crypto will have a huge impact going forward. I think one of the areas that Ethereum in particular is driving is decentralized finance, or DeFi as it's well known. And I still feel that a lot of the work that's being done in DeFi, to me, it seems like the dark web, because it's just like, the websites are like very weird, and like, it's just like it's maybe it's a lack of general understanding, and how these different protocols are operating and building, that it's all like, it just doesn't seem mainstream yet. But I think what's coming out is like some very interesting utilities. For example, I think there's a protocol or a project called Stellar Lumens, and that protocol lets you, it's sort of like the Western Union, but like in very early stage. So you can just send money across anywhere in the world, and I think the transaction costs are lower than what your current choice is, and then obviously the money gets much faster. And I think because there's not enough competition, Lumens being the only player, and that to a very, very greenfield player, there may be a lot of friction and transaction costs. But then once this ecosystem develops, I expect it to be a very, very seamless way in which you can do money transfer. Of course, the whole regulatory challenge is very important, the compliance, the money laundering challenges. So those have to be solved for before they go mainstream. And there's enough of an interest in developers to build those tools and technologies for mass consumption. So I think just leaving it at that there is, it is going to transform definitely financial services. You can just look at anything, whether it's post-trade. I think people are talking about the GameStop and the short squeeze, and single share being shorted, 100 times or even higher. And if you can sort of have a blockchain-based tracking mechanism, and you do locates before you short, and you can only one person can do a locate, not 10 on a single share. I think it just opens up so many possibilities. So I'm a big believer in crypto, and I think AI will, from a perspective of AI, I think the data for crypto is hard, because if you go straight to the chain and try to read the data there, it just becomes a harder deal in real time, especially. So I think there's just like a lot of maturity that needs to come in along every single aspect of crypto space, but I think it's coming.
Douglas, I want to switch back to a question for you on the role recent advances, e.g. general adversarial networks, transfer learning, will play in making AI resilient and scalable for industry.
Yeah, so I think that kind of goes back to something we were talking about at first, which is what kind of about the evolution of AI, right? And when we talk about technologies like GANs, when we talk about technologies like transformers, when we talk about technologies like transfer learning, et cetera, really this is about, to me, the kind of the maturing ecosystem in and around the underlying kind of predictive technologies. And what, the way we see this is it's really, really, and I'm sure everybody here, it's really expensive to build a model once, right? The latest GPT-3 costs something like $100 million just to train, right? I never remember, it was 10 or 100. By the way, it's a lot, and that's before you pay any of your AI researchers. So you need to be able to reuse them. And so when we look at technologies like transfer learning, all of a sudden we can reuse it at a fraction of the cost. And this means that there are business cases we can build around it. There are ways for people on the buy side, there are ways that we can take strategies that work for one asset class that were really expensive to build and maybe use them for a new asset class like crypto. For NASDAQ, it means we can build something for one exchange and use it on another. If we look at things like generative adversarial networks, we have a similar kind of thought around how we can make our current models more resilient by really generating much more, we can generate much more robust and much more robust data that can serve as counterexamples, particularly at the tails to what we're currently seeing. And that's a huge challenge that we have. And I think really the maturing ecosystem of AI is about exactly that, the use of generative methods and transfer methods to lower the cost of applying models to new areas.
Yeah, I mean, you're someone who's had a proven track record of bringing efficiency with machine learning. So you've done work with unsupervised machine learning, right?
Yep, absolutely.
Is that something you've applied both at Boeing and NASDAQ, or just one of the two? And how has that shifted? I mean, what an awesome shift going from Boeing to NASDAQ. I'd love to know a little more about that as well.
Yeah, so absolutely. So when applying them at both places is actually very similar, right? And this is this was frankly what I told the recruiter at NASDAQ is, what's the change going to be like? Well, it's all just
like, would Boeing look at
right?
sentiment analysis ever, or is that not?
Yeah, but it's going to be a different sort, right? So
really? Okay.
The point here, they're going to look at sentiment, but the sentiment's going to be less about whether or not, in my role there in manufacturing, whether or not a mechanic was happy or sad. They're always kind of sad, but more about how big of a problem they thought a particular defect might be, or how pernicious or difficult to fix. And we might be interested in questions like that when it comes to sentiment. Likewise, with a lot of unsupervised learning, there you're much more interested in the location of things and in the location of things, the meaning of words, and how they help you fish out what's going on in a factory that was at the time the world's largest building, and when it was being built allegedly had its own weather patterns. To when you come to NASDAQ, so the problems that you're turning these things on change, but the underlying math is still basically the same, which makes it fairly flexible. Now, so in that sense, the skill, right, the skills, the knowledge transfers fairly well across domains, but and what we like is kind of our models to be equally transferable across domains, so that when you spend all this money, time, and effort building a model that's pretty okay at the general parlance of English in GPT, whatever number they're on now, that you don't have to spend the same amount of money to get it to be able to talk about earnings transcripts or the sorts of language that we'd see in corporate disclosures. Because frankly, if you take something like GPT and have it talk about a liquid asset, it's going to think you're talking about water, and not what the way that we usually talk about it today. So I think that's really the crux of transferability here. Is we like our models to be as resilient and transferable as kind of the underlying mathematical skills and reasoning that many of the practitioners have across domains as well.
Let's jump over to Peng, who has a question from Anonymous. Along this discussion of how you need to transition when the marginal utility of a data source is declining, how do you know? This seems to be more algorithmic than data. So how often are you moving off standard model? Hello?
Yeah, I guess it's in the answered section.
Oh, you answered that already? Or?
Oh no, sorry, that was my bad. I moved it over too quickly. I thought you were reading the chat.
Oh, no worries.
Yeah, if you go to the answered tab.
There we are. So how often are you moving off standard model to more the idea of exploiting new data, e.g., say, abandoned model or something?
Yeah, so how do you know the data source is declining? Well, when it's no longer making money, then we'll try to see what's wrong with it. And one challenge with a lot of these alternative data is that actually the history is actually quite short. So you probably have like 2 or 3 years of data. So a lot of times it's very difficult to assess whether the data source is reliable or not, or whether there's still alpha, is it truly diminished, or is it still is it just a temporary kind of period? So for us, a lot of times we try not to rely on one data set. We try to kind of combine them like an ensemble model, so to speak, so that it doesn't just because one data source has diminished, it doesn't hurts too much the overall performance. And of course, we try to make sure that the signals are as kind of orthogonal as possible. And then periodically you assess these models to see if they still work. And I would say how often are we moving off standard model to more idea of exploiting new data? I would say it's a continuous process. So every day we think about, okay, can we improve the model either in terms of statistical modeling or in terms of utilizing new data. So it's a continuous process, I would say.
Sameer, would you like to jump in there?
Yeah, I think Peng had really good answers. So I think obviously when you're running an ensemble model, I think the right way to think about this is if you can do alpha attribution based to the signals that you're getting from each of the constituent signals. It's a hard problem, but I think there are ways in which you can get to that. I think that and then sort of tracking that over time. And then putting alerts on to make sure that, if the deviations start becoming bigger and bigger from your historical values as well as, with the peers, I think that's a time for you to take a look from a statistical model perspective. I think back to Peng's point on data sets, I think that goes to, the infrastructure you have set up to screen data sets and, to an existing model, if you just swapped out the data source, for example, again, credit card, source A to source B, how does the overall signal look like in tests, both, out of sample testing, as well as, compared to the signal attribution for the old source, how does it compare? And then if it compares favorably, then you know that this is a data set worth bringing in and sunsetting the original source.
Great point, Sameer. Douglas, do you want to jump in there?
Sure. So I guess we probably have a different view of this because our models in production are much more on an operational tempo, right? So unless something catastrophically fails, then we're just kind of either updating it in an automated online sort of way, or we update it once a month, once a quarter. And if it's looking like the model isn't working so well anymore, that's when we really kind of look to improve it. But generally speaking, our clients who either consume data coming out of our models or who use systems that use our models are fairly reliant on them being stable and not being updated in an ad hoc way. So I think we take a much more operational view of updating our models and changing data sources than I think Sameer or Cheng do.
So next question goes to you, Douglas. When analyzing a candidate, do you care more about their ability to program cleanly or their knowledge of machine learning, mathematics? Or is it any comment really?
Yeah, so for me, I think it's the latter. The way that our machine learning lab is structured, machine intelligence lab is structured, is that we have data scientists, machine learning researchers, and then we have our software engineers. And for the vast majority of applications that we have, they're overnight. They can be done as overnight batch jobs, right? And when you're talking about something that's going to run either once a day for a couple hours or once a quarter for a couple hours, coding it super clean so it's highly optimal almost doesn't matter, right? If you're going to run this thing 4 times a year and it takes 2 hours to run it in a non-clean way versus an hour and a half in a clean way, who cares? I've just saved like $3 of compute a year. Woohoo! And by the flip side, the flip side then being, well, if the trade-off is I have to, in order to get somebody who can program in a super clean, ultra professional way, I've got to give up on somebody who kind of knows the underlying mathematics, understands how to apply it. Then I know which direction I'm going because I'm a huge believer in comparative advantage and specialization. So mostly we're mostly looking for somebody who can code well enough, but then has a deep understanding of the underlying mathematics and principles.
Very cool. Peng, you want to jump in here? tell us what you look for in evaluating candidates?
Yeah, I think for a team, you probably want people with complementary skills. But if I were to build a team from scratch, what would be the first hire? I would say, yeah, knowledge of models, machine learning models, statistical learning models are important. Equally important, I would say, would be kind of an intuitive feel for the financial market and data you're looking at, so that you know which model goes with what kind of problem. Because at the end of the day, nowadays, to deploy a machine learning model is no more than typing in a line to download a package from the internet, right? So like that kind of knowledge is valuable, but I think more valuable is to say, okay, I'm looking at, let's say, asset return data. Now, should I use, for example, recurrent neural network on it? Well, probably not, right? Because asset returns don't actually have memory, right? But whereas if I look at volatility data, then okay, maybe it makes sense because their volatility has memory. So in like knowledge like this, I think is quite important, and it really saves a lot of time and effort. Just saves you a lot of trouble of, first of all, you applying the wrong model, secondly, overfitting these models. So I think that's probably an equally important, if not more important, quality I would look for.
And Sameer, please tell us what you're looking for. And
yeah. So I think all of what Doug and Peng said clearly is very relevant. I think I will then just broaden the scope here, which is not only do I want to create a model that works, but then also be able to deploy it, right? So I think if you were to expand that scope, you are looking at a team and that's my sort of recipe for a good team to solve AI problems, is a team which is cross-disciplinary. So you want to have depth of skills in each person. So there is an ML expert, exactly the point that Peng made. That person can just bring real deep, intuitive sort of expertise in addition to operationally working with ML models, deploying them. So that's your ML sleeve. Then there's a deep engineering sleeve, which is what Doug mentioned that he doesn't have to deal with. But obviously, if Doug, you had to sell a product, you would probably need that, which is, okay, the model is now created. How do I now make it deployable and easy to consume and easy to understand, easy to use? So, engineering expertise, but also across all of these things, you want to be able to have your engineer be curious enough to know, the basics of machine learning and curious enough to keep learning, not just start with basics, but keep going up. Same thing on the ML side, the ML person should be able to do some basic hacks, but then also be, so the point I'm making is it a cross-trained team with like very strong depth and then breadth where the whole team can, they're sitting around a table, they can all understand what's going on. I think that's critical.
That's very, very well said. I want to go back to something that I know I'm not a panelist, but I just want to leave my opinion on a data set with declining value. Just very simply put, since I'm not a panelist, I would rather try and use different and new tools on an old data set than start playing with a new data set. That's just my view. But hey, one man's opinion is, not always everyone's favorite. So let's jump back to Douglas for our next question. Douglas, right now, there's a big kind of reinforcement learning versus deep learning conversation going on in finance, and I was wondering if you would weigh in on that. Your feelings.
Yes, I have many feelings. So first, I think if anybody is curious about reinforcement learning and wants to learn more about what distinguishes it from, say, deep learning, and to demystify it a little bit, one of the greatest resources on the planet is Richard Sutton put Introduction to Reinforcement Learning up on the internet for free on Incomplete Ideas. So go there, check it out, and it'll kind of give you a good primer if you're new to this.
I've read it. It's good.
it's pretty good.
It is pretty good.
Yeah, good intro to the space. Yeah, so our view of these two technologies is kind of as follows. Really, when we think about machine learning, we think about it in one of three buckets, being either enabling predictive capabilities, perceptive capabilities, or control-based capabilities. And deep learning really to us is about perception. That is the ability for a machine to not think like a human, because that's not what they're doing, but to look like it's thinking like a human about certain cognitive tasks, and to not really necessarily predict the future, though, and do that with it, but really to understand what's going on in front of it and make some judgment calls about what it's seeing, right? So not just saying that the temperature tomorrow will be 57 degrees, but whether or not that's warm, right? That would be a good task for, that'd be a good task for a deep learning system to do, to make that sort of judgment call. Reinforcement learning to us really fits that control element, right? Where we want to go from having a perceptive system that sees, oh, it's raining outside, to a control system that says, so bring an umbrella, right? So carry an umbrella with you. Or maybe more accurately, a perceptive system might see that I'm in Boston right now, it's pretty gray, it's pretty cold out, and our control system might then suggest interventions that prevent you from getting your shoes torn up by snow, ice, and slush as you head out for the day. And that's really the core difference in the two for us, is whether or not you want to let your entire decision be made by AI, or whether it's merely an input to your decision process, a perceptive input to your decision process. To kind of reiterate some of my points I made, or some of the statements I made earlier, RL is maturing very quickly. RL and at least maybe not hard forms of RL like policy gradients, but at least things that look very RL-like are certainly in our pipeline for deployment, and even have been deployed, and are becoming more and more ready for prime time every day, and not just for playing games and trying to beat people at poker who still play poker online. I think that's kind of my view, though. Or that's our view of the distinction between the two.
I'd like to jump in here. Richard Sutton is one of the most esteemed professors probably on the planet, with Jan LeCun, Andrew Naga, Professor Yoshi Ben. I always forget it. Ben. Anyway, nevertheless, these are the professors whose research I follow and read. Anything they come out with. Anyway, Peng, do you want to jump in on the RL versus DL conversation?
Yeah, actually, I spent a fair amount of time looking at reinforcement learning, but the issue I have with reinforcement learning is that I really struggle with finding a meaningful use case for it. It's good to hear that some of my colleagues here, and maybe some of the presentations here, will talk about the application of reinforcement learning, but I generally find it to be kind of the requirements for it to work is quite high, because you really not only have to kind of forecast one outcome, as Douglas said, you have to kind of forecast a range of outcomes, basically forecast the entire environment, which makes the requirement for forecasting, the bar for forecasting much higher. Now, my thinking is if you're able to make these kind of forecasts so accurately, that maybe you don't even need to be bothered with anything else. You can just forecast returns, right? And buy and sell the stock. So for me, I really struggle a bit. I think the application is probably going to be very, very specific, in the sense that you can probably apply it in some scenarios where it is possible to kind of make reasonable forecasts of not only kind of like a point estimate, but also the distribution. But it seems, for the applications that, for the use case that I'm looking at, I do find it challenging to apply them. Now, deep learning, on the other hand, I would say it's basically an extension of, as I mentioned earlier, right, like linear model. So let's say if you struggle to fit or forecast a certain variable with linear model, maybe you can try deep learning, adding more parameters. There are always use for it. Of course, And as I mentioned before as well, it's not necessarily the case deep learning is always better than linear models. In fact, most of the time, linear models do perfectly well. But I do happen to find some use cases where deep learning would work. So far, I would say, I have found good use case for deep learning, put it into production, whereas for reinforcement learning, it's been a struggle so far.
And reinforcement learning is more connected to psychology and neuroscience, if you will, and that's something that Professor Sutton has written about, and that's very interesting. But sorry, Sameer, your thoughts? Do you have on RLDL?
Yeah, I think deep learning is what I have seen for the most part being used, and I think all the specifically within deep learning, the use case that's getting better and better is natural language processing, and just using that, as long as you can have a lot of again input data and training data. I think deep learning is fast maturing to be a good solution for working with unstructured text. I think RL is when it comes to finance, I think you have to pick very specific use cases where, remember, it's all about exploration and exploitation. So RL will explore and then exploit, and then it'll continue to explore. And I think in finance, you just have to find use cases where when it's exploring and failing, that punishment or the penalty is not high enough to sort of to economically disincentivize that process, right? So I'm thinking about deploying that in a real situation in finance. So you almost have to find use cases which are not in the front office, where it's not very closely related to making investment decisions, but I think it's some process that you want to do, and you can expect it to go wrong and make wrong predictions without much of an implication, and then over time, this thing will shine, obviously. So I think that's my view on that, and again, haven't really seen much from that sleeve come through into actual use cases.
Interesting. I guess, Douglas, I'd like to shift back to you right now and talk about reinforcement learning and deep learning actually at Boeing, and give your views on that. Sorry, if you don't mind, I'd love to hear it.
Sure.
I'm very fascinated by reinforcement learning right now versus deep learning, and when to use them and how to use them. So I just,
So absolutely, I can answer that question very easily. We didn't do any when I was there, but I think actually I'll instead use this as an opportunity to, I think, maybe piggyback on Sameer's comments there. When we think about applications of deep reinforcement learning or reinforcement learning, we really see these as being potential game changers for the next generation of things like market structure, right? And not necessarily as much the next generation of strategy generation. These market structures are the thing. Market structure is a series of controls, and you want to be able to play with them and figure out what the best set is to get various sorts of specific outcomes with regard to a specific set of market quality metrics that traders would care about. So those are the sorts of things where we really see our deep RL as a game changer, is the ability to create really dynamic, fast and really dynamic, extraordinarily high performant markets that produce extraordinarily high market quality in a wide variety of market conditions. And that's, I think that's very very similar to Sameer's comments that maybe this is more about kind of the middle office, back office than the front office.
I guess, Peng, my question is to you then. Do you think reinforcement learning is more suited to stocks then, and deep learning would be more suited to economic predictions? Or is that just,
I think the difference between, let's say, stocks and economics predictions, economics prediction is a time series prediction. Okay, so also frequency tends to be low, whereas stocks, you have luxury of a cross section. Let's say in the U.S., you probably have 9,000 underliers globally.
Wow, very well said. Wow, great answer.
Many more than that. So the bar for kind of cross-sectional estimate in the equity universe is much lower. It's much easier to create a cross-sectional model and have good predictive power. So I think that's kind of what makes stocks unique from economics time series. And so I guess in a way, as I mentioned before, it's probably easier to kind of create deep learning model relative to reinforcement learning. That's my perception. It maybe for economics, it's at least more obvious to apply deep learning. Reinforcement learning is probably a little bit less obvious, whereas on stocks, maybe there could be use cases for both.
Sameer, do you have anything to add here?
I would think, Alex, as I think about this, for stocks, RL could be something where, if you really thought about like stock prices moving in a very random walk way, right? Like from one tick to next, and this probably does not take care of any fundamentals in the company or, how well the company is doing. So it's really like, just like, tick up or tick down, or up and up or down, down. I think that might be something, and I've never done it. Like I'm almost like thinking out loud here that RL could be, an interesting sort of way to look at, can you predict that stock price movement based on the context, right? Based on what the other ETFs are doing and things like that, based on what your peers are doing. So you create some context for that. And then you say, well, you just have to predict whether you're going to be up, up, or up, down. And then how well can you clone that actual sort of movement that ends up happening in the market? I think it'll be a fascinating exercise and, potentially a use case for RL.
No, I can say that Rebellion's deep learning has done better on economic calls, and our reinforcement learning has done better. Well, we actually have a deep reinforcement learning that we use for our stocks, and the deep RL does not do as well on larger economic calls as the deep learning does. Economic calls tend to be kind of more deeply rooted, and so whereas reinforcement learning is maybe a little more topical. But we've got like 90 seconds. And so I want everybody to be able to give their concluding thoughts. So Douglas, do you want to start us off with your concluding thoughts on the day or for life?
Well, thanks, Alex, for hosting this, and thanks for having me. The one last, since RL is one of my favorite topics, my one last little pitch for it is that one of the great things about reinforcement learning, aside from its ability to continuously learn, is its ability to be made advantage aware. And I think that's going to help me tie my closing thoughts together, because really a lot of what we talk about when we talk about machine learning in finance is how we find advantage, whether that's advantage in market structure or advantage in trading, and the push towards machine learning and the ability to find, automate in some sense, that searching for that advantage is something that I think we're not going to see go away anytime in the future.
So, definitely. Peng?
Yeah, I think machine learning is still a very promising field. I think maybe what happened in 2020, you might have heard, okay, some quant funds lost vast amount of money in 2020 because their models didn't work. But I would say actually this is a very valuable experience, because it made new data available to us, made us recognize the shortfalls of existing models. So what doesn't kill makes you stronger. So I think with the experience 2020, we'll be able to have more better understanding, and create new and better models going forward.
Yeah, no, it's been crazy seeing renaissances to outside funds drop 20 and 30%, and I know Miami, University of Miami, obviously it's not as investors was not happy with that, but I mean, so many people are investors in Renaissance, but then to see their internal model go up 75% can be rather frustrating. Nevertheless, 2020 was a bad year for quants, without a doubt. Sameer, do you want to give your concluding thoughts?
Yeah. So first of all, thank you, Paul and Alex, for having me on this. I think given that this is an academic conference, I'm sure there are students on the listening in. I think my piece of advice to them would be focus on the problem. I think AI, ML, Python, data, these are all means to an end. And if you focus on building the best model and ignore the problem, you will be on a different, you will not meet the actual user, and it's very important. So put yourself in their shoes and think from their perspective, and then go back the fact and then solve the problem. So that's the only piece of advice: be problem driven versus solution driven.
Great advice. Well, thank you, Professor Barashon, for putting this conference on. This was a lot of fun. You three panelists are all brilliant, fantastic individuals, and I feel very thankful and humble that you were willing to donate your time to this academic endeavor. So everybody stay safe and be well during these crazy times.
Thank you.
Thanks so much, Alex. Thank you, Sameer,
Bye.
Peng, and Douglas. This was absolutely wonderful, a true treasure trove of insight into how these things actually play out in very pressing real world problems.